Every time you open financial news today, it almost feels like the same story repeating itself. The U.S. stock market is hitting record highs again and again, even when the world around it seems uncertain. Inflation has been high, interest rates have been at levels not seen in years. Global tensions keep rising, and yet the markets continue to climb. For many people, this feels confusing, almost disconnected from reality. But the truth is, the market is not ignoring reality. It is responding to a different version of it, one that is based on expectations of the future rather than conditions of the present. To understand why U.S. markets keep reaching new highs, you have to look deeper than headlines and short-term fear, and instead understand the powerful forces working underneath the surface. One of the biggest drivers behind this constant rise is something called liquidity, which simply means the amount of money flowing through the financial system. Even when central banks like the Federal Reserve raise interest rates to slow down the economy, they do not remove money from the system completely. Instead, money shifts around. Trillions of dollars remain parked in institutional funds, money market accounts, pension funds, and global investment pools. This money is always searching for returns, and when it is not finding attractive opportunities elsewhere in the world, it often flows into U.S. markets. The United States still represents the deepest, most liquid, and most trusted financial system globally, so capital naturally gravitates there. This constant flow of money creates steady upward pressure on stock prices over time, even when short-term sentiment feels negative. Another major reason behind record highs is the dominance of a small group of massive companies, especially in the technology sector. Unlike previous decades where market growth was spread across many industries, today a handful of companies carry a huge weight in the overall market indexes. Companies like Apple, Microsoft, Nvidia, Amazon, and Google are not just growing businesses anymore. They are foundational pillars of the global digital economy. They are leading artificial intelligence, cloud computing, digital infrastructure, and advanced software systems that power the modern world. Because of their size and influence, when these companies perform well, they pull the entire market upward with them. This creates a situation where even if many smaller companies are struggling, the strength of these giants keeps the major indexes climbing higher. At the same time, investor psychology plays a huge role in sustaining these highs. Over the past decade, investors have experienced a consistent pattern where every major market drop has eventually been followed by a recovery. Whether it was the COVID crash, banking fears, or inflation shocks, each downturn was eventually followed by a rebound. This has created a strong belief in the mindset of buying the dip. Instead of fearing declines, investors now often see them as opportunities to enter the market at better prices. This behavior creates a powerful self-reinforcing cycle. When the market drops, buyers step in. When buyers step in, prices recover. And when prices recover, confidence returns, encouraging even more buying. Over time, this cycle becomes one of the strongest forces pushing markets higher. Corporate earnings are another critical piece of this puzzle. Despite higher interest rates and economic pressure, many large U.S. companies have remained surprisingly strong in terms of profits. The reason is adaptability. Companies have become more efficient, streamlined their operations, reduced unnecessary costs, and invested heavily in automation and technology. At the same time, the American consumer has continued to show resilience, spending steadily on services, travel, technology, and healthcare. This combination of efficient corporations and stable consumer demand has helped maintain strong earnings across many sectors. And in the stock market, strong earnings are one of the most direct drivers of rising stock prices. Another important factor is how the Federal Reserve influences expectations. Markets do not just react to current interest rates, they react to what they believe will happen in the future. Even when rates are high, if investors expect that the Federal Reserve will eventually lower rates, they begin to position themselves early. Lower future interest rates mean cheaper borrowing costs for companies, higher potential profits, and more attractive valuations for stocks. This forward-looking behavior means that the market often starts rising before actual policy changes happen, based purely on expectation and anticipation. On top of all this, there is a global dimension that strengthens U.S. markets further. In times of global uncertainty, investors across the world tend to move their capital towards safer and more stable financial systems. The United States, with its strong institutions, innovative economy, and deep financial markets, remains the primary destination for this global capital flow. Whether uncertainty is coming from Europe, Asia, or emerging markets, a significant portion of international money often finds its way into U.S. equities. This global demand adds another layer of consistent buying pressure, helping support higher valuations. When you combine all of these forces together, liquidity in the system, dominance of major tech companies, strong investor psychology, resilient corporate earnings, forward-looking interest rate expectations, and global capital inflows, you begin to see why the U.S. stock market continues to hit record highs. It is not driven by a single reason, but by a complex system of interconnected factors all moving at the same time. Each force supports the others, creating a powerful upward structure that is difficult to break in the short term. However, it is important to understand that record highs do not mean the absence of risk. Instead, they reflect high expectations about the future. The market is constantly pricing in what investors believe will happen next, not just what is happening today. This is why markets can continue rising even when the present feels uncertain. But it is also why sudden corrections can happen when expectations shift. The same forces that push markets upward can also reverse quickly if confidence changes. In the end, the real reason U.S. markets keep hitting record highs is not a mystery or a single event. It is the result of a global financial system that is constantly moving, adapting, and pricing in the future. It is driven by money flows, technology dominance, human behavior, corporate strength, policy expectations, and global trust all working together. And as long as these forces remain in place, the story of rising markets is likely to continue, even through periods of fear and uncertainty.